The stock market is like a vast ocean with its own currents, tides, and storms. It can be both beautiful and terrifying, offering opportunities for great rewards but also posing significant risks. Navigating these waters requires skill, knowledge, and the right tools. Just as a seasoned sailor wouldn't venture out without a map and compass, a trader needs reliable strategies and indicators to make informed decisions. One of the most valuable tools in a trader's arsenal is the moving average. This simple yet powerful indicator helps traders smooth out price data to identify trends over time. Moving averages help us see past the daily noise of the market and identify the underlying trends that can guide our trading decisions. They filter out the short-term fluctuations, allowing us to focus on the bigger picture. Just as a sailor uses a compass to chart their course, traders can use moving averages to navigate the financial markets with greater clarity and confidence. These averages act as a guiding light, helping traders stay on course even when the market gets rough. Imagine you're trying to cross a choppy harbor. The waves are unpredictable and the water is turbulent. Looking only at the waves around you, it's hard to know which way to steer your boat. The constant ups and downs can be disorienting and make it difficult to maintain a steady course. But if you can spot a buoy bobbing gently in the distance, you can use it as a reference point to guide your journey. This stable point helps you navigate through the chaos. Moving averages act like those buoys, providing stable points of reference in the turbulent sea of market data. They help traders maintain their bearings and make more informed decisions. In this essay, we'll delve into the world of moving averages, exploring two popular types: simple moving averages, SMA, and exponential moving averages, EMA. Each has its own unique characteristics and applications. We'll learn how to interpret these indicators, uncovering the secrets they hold for identifying trends and generating buy and sell signals. Understanding these signals can be the difference between a profitable trade and a missed opportunity. To bring these concepts to life, we'll examine real-time examples from the Nifty 50, focusing on prominent stocks like Tata Steel and ICICI Bank. These case studies will illustrate how moving averages can be applied in real-world trading scenarios. Whether you're a seasoned trader or just starting your journey in the financial markets, understanding moving averages is essential for making informed trading decisions. This knowledge can help you navigate the complexities of the market with greater confidence. So, let's set sail and explore the power of these invaluable technical indicators. By mastering moving averages, you'll be better equipped to ride the waves of the market and achieve your trading goals. Moving averages are like magic glasses that help us see the true picture of the market by filtering out the noise. They allow traders to focus on the bigger picture rather than getting lost in the daily price fluctuations. They work by averaging a security's price over a specific period, smoothing out the day-to-day fluctuations and revealing the underlying trend. This makes it easier to identify whether a market is trending upwards, downwards, or moving sideways. Think of it like looking at a mountain range from a distance. Up close, you might only see individual peaks and valleys, which can be confusing and overwhelming. But from afar, the overall shape of the range becomes clear. Similarly, moving averages help traders see the overall direction of the market, making it easier to make informed decisions. Moving averages come in different flavors, each with its own way of calculating the average price. This variety allows traders to choose the type that best fits their trading style and objectives. The two most common types are the simple moving average, SMA, and the exponential moving average, EMA. Each has its own unique characteristics and advantages. Both offer valuable insights into market trends, but they have distinct characteristics that make them suitable for different trading styles and timeframes. Understanding these differences is crucial for effective trading. SMAs are like steady old ships, providing a reliable but somewhat delayed view of the market. They are often used by long-term investors who are more interested in the overall trend than short-term price movements. They calculate the average price by giving equal weight to all data points within the chosen period. This makes them less sensitive to recent price changes, providing a smoother and more stable trend line. EMAs, on the other hand, are more like nimble speedboats, reacting quickly to recent price changes. They are favored by short-term traders who need to respond swiftly to market movements. They give more weight to recent data, making them more sensitive to current market sentiment. This allows traders to capture trends earlier, but it can also lead to more false signals. Choosing the right moving average depends on your trading strategy and the time frame you're analyzing. It's important to consider your goals and risk tolerance when selecting a moving average. Shorter-term traders might prefer EMAs for their responsiveness, while longer-term investors might favor SMAs for their stability. Each type has its own strengths and weaknesses, so it's essential to understand how they work. The key is to experiment with different types and periods to find what works best for you. By testing various moving averages, you can discover which ones align with your trading style and objectives. No matter which type you choose, moving averages are powerful tools that can help you identify trends, spot potential buy and sell signals, and navigate the markets with greater confidence. They are an essential part of any trader's toolkit, providing valuable insights that can enhance your trading performance. The simple moving average, SMA, is the most straightforward type of moving average, often serving as the first step for many traders and investors in their journey into technical analysis. It's like the foundation of a house, providing a solid base upon which we can build our understanding of more complex indicators and trading strategies. The SMA calculates the average price of a security over a specified number of periods, with each period given equal weight, making it a simple yet powerful tool. Imagine you want to calculate the 10-day SMA of a stock. This process involves a straightforward calculation. You would add up the closing prices of the last 10 trading days and then divide the sum by 10. This gives you the average closing price over those 10 days. The resulting figure is the 10-day SMA, which smooths out daily price fluctuations and provides a clearer picture of the stock's trend. Each day, as a new closing price becomes available, the oldest price is dropped from the calculation and the newest one is added, ensuring the SMA remains up to date. The SMA is plotted on a price chart as a line, providing a visual representation of the average price movement over time, which can be easily interpreted by traders. When the price of the security is above its SMA, it suggests that the security is in an uptrend, indicating potential buying opportunities. Conversely, when the price is below its SMA, it indicates a downtrend, which might signal selling opportunities or caution. Traders often use SMAs of different lengths to identify trends and potential trading opportunities, tailoring their strategies to their specific goals and timeframes. For example, a trader might use a 20-day SMA to identify short-term trends and a 50-day SMA to gauge the longer-term direction of the market, combining both to make more informed decisions. The SMA is a versatile tool that can be used in conjunction with other technical indicators to confirm trends, identify support and resistance levels, and generate buy and sell signals, making it an essential component of any trader's toolkit. Section 4. Exponential Moving Averages, or EMA, giving more weight to the present. While the simple moving average, or SMA, treats all data points equally, the exponential moving average places greater emphasis on recent price data. This makes the EMA more responsive to current market conditions and less prone to lag behind significant price moves. Think of the EMA as a weighted average, where the most recent data points carry the most weight. As we move further back in time, the weight assigned to each data point decreases exponentially. This allows the EMA to react more quickly to breakouts, reversals, and other significant price movements. The calculation of the EMA is a bit more complex than the SMA, but most charting software platforms do the heavy lifting for us. The key takeaway is that the EMA is more sensitive to recent price changes, making it a valuable tool for traders who need to stay ahead of the curve. EMAs are often favored by short-term traders and those who focus on momentum trading strategies. They can be particularly useful in volatile markets where prices can move rapidly in either direction. Similar to SMAs, EMAs can be used in conjunction with other technical indicators to confirm trends, identify potential entry and exit points, and generate trading signals. Section 5. Nifty 50 Examples. Tata Steel in focus. Let's now turn our attention to the Nifty 50, India's benchmark stock market index, and see how moving averages can be applied in real-world scenarios. We'll start with Tata Steel, a multinational steel manufacturing company and a prominent constituent of the Nifty 50. Looking at a chart of Tata Steel's stock price with a 20-day SMA and a 50-day SMA overlaid, we can see how the interaction between the price and the moving averages can provide valuable insights into the stock's trend. When the price is consistently trading above both the 20-day and 50-day SMAs, it suggests strong upward momentum and a potential buy signal. Conversely, when the price falls below both moving averages, it indicates a shift in sentiment towards the downside and a possible sell signal. Crossovers between the 20-day and 50-day SMAs can also generate trading signals, with a bullish crossover, meaning the 20-day SMA crossing above the 50-day SMA, suggesting a potential buying opportunity, and a bearish crossover, with the 20-day SMA crossing below the 50-day SMA, signaling a potential selling opportunity. It's important to note that moving averages should not be used in isolation. Traders often combine them with other technical indicators such as volume, momentum oscillators, and candlestick patterns to confirm their trading signals and improve their odds of success.